Good afternoon. Now that you have completed in Excel the day one transactions for your shoe store company, you will continue to build the financial statements previously started in Assignment 10. The goal here is to make our financials look more like those for a real company. Therefore, we will include sales and the related cost of goods sold and the purchase of inventory previously included in Peachtree transactions. In addition, we will include salaries, wages, and other expenses such as rent, utilities, etc. The months to be completed will be the remainder of month 9. Day 1 is the first day of month 9, and month 10. The following variables, which are highlighted in green in the attached model, are included. So what we are going to do is start putting in our variables, and as I noted in the last lecture, the order in which we prepare these financial statements is to do the income statement, statement of cash flow, balance sheet, and then the indirect cash flow statement. So we'll start with our income statement. So in our income statement in month 9, we have sales. These are the variables that I've noted in the lecture. We have sales of $150,000, and cost of goods sold is 70% of that number. If you remember, we sell shoes for $100 and we buy them for $70, so cost of goods sold is 70%. So we have the formula equal 0.70 times the shoe sale, or 105,000, and this number should be negative since it represents an expense. And then we want to write in the other expenses. So we have salaries of $34,167. Put a negative sign in front of it. We have wages of $31,667. Put a negative sign in front of it. And we have other expenses of $30,000. Put a negative sign in front of that. And now we can take net income. Net income is equal to the sum of this row of numbers, column of numbers. So we show a $50,834 loss. Not unusual for a company in the first stage of its birth. Okay. Our next task is to do the cash flow statement, direct cash flow statement. We have beginning balance here. Beginning balance in our cash flow statement. Well, the beginning balance is equal to the ending balance from the previous month. So we have this ending balance here of $4 million. So we can link our beginning balance to that. So that equals 4 million. And all that means is that the column is not wide enough. Right? So we can get rid of the decimal places. The next line is cash from customers. This is part of our inflow. If you remember, we sold shoes to Macy's, $150,000 worth of shoes that we see here in the income statement, and we collected it almost immediately, so that was our cash from customers. So we need to link this to that, and that's our cash from customers. The next line is cash to vendors. Well, our cash to vendors happen to be the amount of money that we spent on those shoes. We purchased $1,001,000 worth of shoes. So this number, and this is an expense, this number will equal minus 1,001,000. And our other operating expenses will be all of these expenses here. So we can take a sum of those. Equal sum right down. And those are our expenses. And so we need to format these so that they all look alike. We format them comma format, take away the decimal places, and now we have what we're supposed to have. So this is the total cash from operations. We have no additional financing this month. We have no additional loans this month. We do have, though, purchase of fixed assets. We have purchased fixed assets. So we want to represent that by equal minus 200,000 as a cash flow out. Format that so it looks like the others. Okay, so we bought $200,000 of fixed assets in the first month, and our total cash in will be the sum of these numbers. So if we go equal sum and then scroll down, we have this as our total cash at the end of month 9. You notice that cash has decreased because of these uses. So now we finish with our cash flow statement, and now we go to our balance sheet. Now, the balance sheet cash should be, this cash should be equal to that. We already have a formula that represents that. We should also format this box, this cells, range of cells. So if we get rid of these decimal places, and we should just be able to drag this over. And yes, so this equals this below, which is what it's supposed to. And now we have inventory. What is our inventory balance that's on our balance sheet at this stage? Well, we purchased $1,001,000 worth of inventory, and we've used $105,000 of it. So the difference between those two numbers is what this balance is. So being careful of the signs, because we have negative numbers, but we want to control them, and we want this to produce a positive number, we say equal, and we want to make this into a negative number, so equal minus this, so that will be a positive number now, plus this negative number, and we wind up with 896,000, which is the number that we want. Then we have fixed assets here, and our fixed assets can be tied to the purchase of fixed assets. We want to make sure that this comes out as a positive number, so we should put a negative sign in front of it. So equals purchase of fixed assets. And we can have a total here, $3,949,166. This loan payable, we have that in the next month, so we want to be equal to that. We have equity, we want to be equal to this. And we can take a total here. And the thing that we're missing is retained earnings. So we need to tie this into the net income. So that's equal to that. And we have a balance sheet that is the same. Assets equal liabilities and owner's equity plus owner's equity. This is the end of part 1. Turn to part